Welcome. Today, we're exploring a cornerstone text in investment literature, Burton Malkiel's A Random Walk Down Wall Street. First published in 1973, this book has guided generations of investors. It challenges conventional wisdom about market predictability. Malkiel presents a compelling argument for a specific investment philosophy. His core thesis is both simple and profound. It suggests that predicting market movements is far more difficult than many believe. At the heart of the book is the concept of the efficient market hypothesis. This theory posits that asset prices fully reflect all available information. In an efficient market, prices react instantly and correctly to new data. This means that at any given time, stock prices are a fair representation of their true value. Consequently, consistently finding undervalued stocks or predicting price changes becomes exceedingly difficult. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Malkiel critically examines popular methods used to beat the market. He looks closely at both technical analysis and fundamental analysis. His findings are often skeptical. Technical analysis relies on studying past price movements and patterns. Technicians believe history repeats itself, offering clues about future prices. Malkiel argues that in an efficient market, past price data has no predictive power for the future. Fundamental analysis involves evaluating a company's intrinsic value. Analysts study financial statements, industry trends, and economic factors. They seek to find discrepancies between a company's market price and its calculated true value. While acknowledging the logic of fundamental analysis, Malkiel points out its practical limitations. Information is widely available, and different analysts can reach vastly different conclusions. Market prices often already reflect known fundamentals. This leads to the random walk hypothesis. If markets are efficient, price changes are essentially random and unpredictable. Like steps in a random walk, future movements cannot be reliably inferred from past ones. Malkiel uses the analogy of a blindfolded monkey throwing darts at a newspaper's financial pages. He suggests such a portfolio might perform just as well as one selected by experts. This vivid image underscores the difficulty of outperforming the market consistently. The random walk hypothesis has significant implications for active investment management. If prices are unpredictable, then professional money managers face a formidable challenge. They must not only pick winning investments, but also cover their fees and trading costs. Malkiel presents evidence suggesting that most actively managed funds fail to outperform market benchmarks over the long term. After accounting for fees and expenses, the average actively managed fund often lags behind simple index funds. Based on the random walk theory, Malkiel strongly advocates for a passive investment strategy. This involves investing in broad market index funds. These funds aim to replicate the performance of a specific market index, like the S&P 500. Passive investing embraces market efficiency rather than fighting it. It offers diversification, low costs, and simplicity. By owning a piece of the entire market, investors are likely to capture the market's overall return. Beyond the theoretical arguments, the book offers practical guidance. Malkiel stresses the importance of starting early and investing consistently. Compounding is a powerful force, and time in the market is crucial. He emphasizes the need for diversification across different asset classes. This helps reduce risk without sacrificing potential returns. A well-diversified portfolio is less vulnerable to poor performance in any single investment. Controlling investment costs is another key takeaway. High fees, trading costs, and taxes can significantly erode returns over time. Low-cost index funds are therefore a preferred vehicle. Malkiel also discusses the role of behavioral finance. He touches on how investor psychology, like fear and greed, can lead to market bubbles and crashes. Understanding these behavioral biases can help investors avoid costly mistakes. While markets are generally efficient, Malkiel acknowledges periods of irrationality. He details historical bubbles such as the Dutch tulip mania and the dot-com bubble. These events show that markets can deviate significantly from fundamental value, at least temporarily. However, he argues that predicting when bubbles will form or burst is impossible. Trying to time these events is speculative and risky. A long-term, disciplined approach remains the most prudent strategy. A random walk down Wall Street remains highly relevant today. Its core message about market efficiency and the challenges of active management is supported by decades of data. The book provides a clear, evidence-based framework for thinking about investing. For new investors, it offers a sensible starting point. For experienced investors, it serves as a valuable reminder of the difficulties of consistently beating the market. Malkiel's work encourages a disciplined, low-cost, and diversified approach to building wealth over the long term. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries.